Okay, today we're going to talk about earnings per share. Um, Earnings per share is a required disclosure in U.S. Financial statements that must be presented on the face of the financial state of the income statement. Most other things that are required disclosures can be included either in the financial statement itself or in the footnotes, but not earnings per share. All companies must disclose basic earnings per share, and companies with dilutive, potentially convertible securities must also report diluted earnings per share. And we call this a simple capital structure, the first one, and a complex capital structure is the second one. That is complex because it has dilutive, potentially convertible securities that must, and therefore we must report diluted earnings per share. Let's first talk about a simple capital structure. Earnings per share is one number that is used very commonly to evaluate the performance of a company. It has, for a simple capital structure, there's no stock options or convertible securities that can be converted that could potentially dilute the shares um, and um, make the earnings not as valuable as someone might have thought they were. Because if you held the common shares and you find out that there is convertible securities out there that make your earnings per share not that valuable, that's called, or make the earnings per share go down. That would be diluting your earnings. Dilutive means the ability to influence the earnings per share in a downward direction. So let's talk about first a basic earnings per share. That's simple, straightforward. Sovereign Financial Corporation reported net income of 154 million for the year. Its capital structure consisted of simply 60 million common shares. Its basic earnings per share is 154 million divided by 60 million shares outstanding, or $2.57 per share. That's a basic earnings per share. We calculate that basic earnings per share as earnings available to common shareholders divided by weighted average number of common shares outstanding. It becomes a little bit more challenging under two conditions. Number one, if there are preferred dividends, they remember that the preferred shareholders have priority in terms of access to dividends. And so we reduce the earnings per share to the extent that non-cumulative preferred dividends have been declared. We'll talk about that a little bit more in just a moment. We also um, need to consider the number of shares and to the extent that they've changed during the reporting period. And we'll go into both of those right now. So to consider preferred stock dividends, we subtract the declared current year preferred stock dividend from net income to arrive at what we call income available to common stockholders. Even if they're not declared, if they're cumulative preferred, then they must be subtracted anyway. So it doesn't matter whether they're declared or not. If they're cumulative, they will be subtracted. So what we're talking about now is this numerator part, in reducing income available to common, which is the numerator. Now let's talk about the denominator. Here we've got to weight the number of shares outstanding during the year. And So if a company starts with a few shares outstanding and then issues more shares during the year, we do a weighted average of the shares that are outstanding during the year. I'll show you an example. It's coming right up. Importantly, if there are any stock dividends or stock splits that occurred during the year, we assume that they occurred at the beginning of the year, from the first, from the very first day of January 1st. I'll give you an example of that also. So here, weighted average shares outstanding. You can see here, this is the fact circumstances. This company, Zach Smith, began with 90,000 shares outstanding, and they issued 30,000 more. And then on April 1st, on July 1st, they bought back 39,000. And it doesn't matter whether they retired them or they went into treasury, they're still bought back and they're not outstanding for the purpose of earnings per share. And then on November 1st, they issued another 60,000 shares. So what we need to do is calculate weighted average shares outstanding. And there are two approaches to doing this. One that's used by the textbook, and that's what we're going to talk about right now. Other people who might have done weighted average computations for other purposes, uh, like inventory, for example, may not be used to this calculation right here. So following the textbook says, all right, we started out 90,000 and we multiply 90,000 as if it was that 90,000 is outstanding for the entire year, 12 over 12, because it was there on January 1st. And then at the margin, we issued another 30,000, and that 30,000 was on April 1st. If you count on your fingers, April, May, June, July, August, September, October, November, and December, that's 9 months. And so for the rest of the year, 9 months remain, and it's 22,500 for those. And this is a marginal approach. On July 1st, they bought back 39,000, so we reduced that for the remaining 6 months of the year, and that on a weighted average basis, it reduces our weighted average shares outstanding by 19.5. And then on November 1st, with 2 months left, we issued 60,000 more, which has a weighted average effect of 10,000. So this is the book approach. It's a little bit unintuitive, but it works, and it's the one that's used by the book. All I care about is that you get the answer that works. This is the sort of traditional approach here. And the traditional approach says, what is the balance, and calculate the weighted average for that period of time. So between January 1st and April 1st was 3 months. 3 months is 3/12 over times 90,000, and we get the 22,500. And then there was April, May, June, where we had 120,000 for 3 months, and we multiply that, and that gives us 30,000 for that period of time. And then we had for July, August, September, October, 4 months, we had 81,000 because we bought back 39,000 on July 1st. And so we had 81,000 for 4 months, and that's 27,000 on a weighted average for that 4 months. In the last 2 months, we had 141,000 times 2/12s, 23,500. And when you add these up, you get 103,000, which is exactly the amount that the book's approach does. I don't care which one you use, just get the right answer. Okay, here's an example of preferred dividends and changing shares outstanding. So here we see a company that it's called Cougar Financial Corporation, reported net income of 154 million. Its capital structure included the following. It has 60 million common shares outstanding. 12 million new shares were issued on January 1st. 12 million new on March 1st. Had a 10% stock dividend June 17th, and then they reacquired 8 million on October 1st. So the first thing, if we're calculating the numerator, which is income available to common, that's the net income minus the preferred dividends, which were 5 million shares, $10 par, times 8%, or 50 million times 8% is 4 million, and the income available to common is 150 million. Now let's do the weighted average shares outstanding. Notice that we have this 10% stock dividend on June 17th. That is after January 1st and March 1st when we issued new shares, but before the October 1st one where we reacquired treasury stock. So in order to calculate the way the book does it, we go back and we say the 60 million, we're going to assume that that stock dividend occurred on January 1st. So we go back to the very beginning of the year and assume that it occurred then. And that'll make it 66 million, right? 60 times 1.1 for the entire year is 66 million. And then we added a new 12 million shares before the stock split, but we assume that they occurred that we on January 1st. And that's going to be 12 million times 1.1, which is going to be 13.2 million. For the remainder of the year, 10/12ths, 13.2 times 10/12ths is going to give us 11 million. Then we have the stock dividend on June 17th. We do not adjust anything that occurs after that date because those are already stock splitted shares. And so we have a subtraction in 8 million shares for the remaining 3 months. And again, we're using the book approach here, and we end up with 75 million weighted average shares outstanding. The intuitive approach gets the same answer, and it does it following the alternative or the sort of more to intuitive approach, say 75 million. When we divide 150 million of income available to common after subtracting the 4 million of preferred stock from the dividend or dividends from the net income, we end up with 150 million divided by 75 million shares outstanding, or $2 per common share earnings. And this is basic earnings per share. There's no potentially dilutive convertible securities there. Now, with diluted earnings per share, this includes securities that are not common stock, but could become common stock through exercise or conversion at the decision of the holder of those securities. This is what we refer to as a complex capital structure, and that means we have potentially diluted common shares or potential common shares that are out there. Some of the examples of these: bonds that can be converted into common stock, preferred stock that can be converted into common stock, stock options, stock warrants, those kinds of things that are essentially stock options, and contingently issuable securities. And we won't talk about that in any more detail, but we'll talk about the first three. A firm with a complex capital structure reports two earnings per share calculations under most conditions. It always has to report basic earnings per share. Every public company in the United States must report basic earnings per share. And in fact, I believe under US GAAP, even if it's a privately held company and it has shares, it has to report basic earnings per share on the face of the income statement. Um, they also must include diluted earnings per share to the extent that it dilutes, that is, reduces earnings per share. If you have uh, potentially dilutive securities, but they do not reduce earnings per share, you do not include them in the calculation. They are anti-dilutive. If they're anti-dilutive and there's only one of them, you exclude it and only report basic. If there's multiple ones, if it's each one is anti-dilutive, then you need to remove the ones that are anti-dilutive. Let's first talk about convertible preferred stock and convertible bonds. These convertible securities include an option of the holder to convert the shares of preferred or bonds into a fixed number of common shares. This potentially dilutive effect indicates that we'll have a lower earnings per share. And we do this by pretending that they were actually converted during the year. And that we're at the beginning of the period. And the best way I can explain this is by showing an example. We'll do that in just a second, but the effect of this pretend conversion on preferred stock and on bonds is that the denominator is increased. That is, the number of shares outstanding is increased by the number of shares that it's converted, common shares that it's converted into. The numerator is also increased by the preferred stock dividend that would be avoided if they converted to common stock. So you don't have to pay that preferred dividend. Income available to common gets higher. Or the interest expense that you would not have to pay on the bonds, you would be high, you would have higher income, but then you would also have higher income tax. And so we have the after-tax effect of adding the interest back. And again, I'm going to show you an example. For stock options, these give the holders, as long as they are in the money, that is, the fair value is greater than the exercise price, they give the holder the right to exercise their option at all stock options give you the right to exercise the option at the exercise price, but only the ones that are in the money are considered dilutive, um, because we assume the ones that are not in the money would not convert. And they affect diluted earnings per share, but not basic earnings per share. When we do the stock option, what we do is, because we actually get cash from the holder of the stock option, they must tender the exercise price, and in order to get stock that's worth more at the current market value. And so what we do is we assume that the options are exercised at the beginning of the reporting period, or if they were issued later during the year at that date. And the cash proceeds, that is the exercise price that the option holders tender to the company, is used to buy back shares at the current market price during the year, the average market price during the year. Um, yeah, this this means that the for a convertible bond, this conversion at the beginning of the year, it means that we include in the denominator the number of common shares that are issued, and we include the after-tax effect of removing the interest expense uh, in the numerator. So let's do an example. Mayfield Corporation has net income of $210,000 for the year and a weighted average number of common shares outstanding during the year of 100,000 shares. The company has two convertible debenture bond issues outstanding. One is a 6% issue that sold at 100. That means with a face value of a million in a prior year and convertible into 20,000 common shares. Interest expense on the 6% convertibles is 60,000. That is 6% of a million. The other is a 10% issue sold at 100, also for a total of a million. So the interest expense on that would be 100,000 for a year, but since it's only been it was issued on April 1st of the current year, it's going to be 75,000. So we take the 10% of a million, we get 100,000, and it was issued on April 1st. That is April, May, June, July, August, September, October, November, December. That's 9 months. 9/12 or 3/4 times a million is $75,000 of interest expense. It would be converted into 32,000 common shares, but for that, we use a weighted average for the last 9 months, or 9/12, 3/4 of that. That would be 24,000. The tax rate is 40%. Let's take a look at how we do this. This is for convertible bonds, which is different than convertible preferred in that convertible bonds, you must yeah, exclude the tax effect. All right, for basic earnings per share, we have net income divided by weighted average common shares. And in the net income, we've already subtracted the interest expense. We end up with $2.10 per common share as basic earnings per share. Now, when we go to do our weighted average number of shares outstanding, since we had for the diluted earnings per share, we start with 100,000 shares outstanding, and then we're going to assume that in the denominator these debentures, these bonds, were actually converted. The 6% bonds that were outstanding for the entire year would be converted to $20,000, or 20,000 additional shares. And the 10% bonds would be converted on a weighted average basis for the year, 9/12 times 32,000, into 24,000. So if we assume that these all converted, we would have 144,000 weighted average common shares outstanding. Now we're going to calculate diluted earnings per share. Basic earnings per share, as we mentioned earlier, is $2.10. We have the effect of the 6% debentures, which is 6% of a million is 60,000, that we would not have as an expense. That, remember, the expense was included in getting down to the 210,000. So we are going to add this to net income, but because it's pre-tax, we would also have higher tax of 40% of that. So what we're left over is really 1 minus 0.4, or 0.6 times 60,000, or 36,000, divided by the 20,000 shares that it would be converted into, those bonds would be converted into. And the effect of that conversion is $1.80 per share on the common. And it's smaller than $2.10. So it is dilutive. And remember, dilutive is where you're watering down or making the earnings per share smaller. If it makes it higher, you disregard it because it's anti-dilutive. We only want the ones that reduce earnings per share. We do not want to include the ones that increase earnings per share. For the 10% debentures, 10% of a million is 100,000 of interest times the after tax effect 0.6 is 60,000, and 60,000, remember they were issued on April 1st times 3/4 is going to be 45,000. So that's the numerator in this part is 45,000, and they're convertible into 24,000 on a weighted average basis. They're convertible into 32,000, but we weight that by 9/12. And so the effect of that is going to be a $1.875. Altogether, they are dilutive, such that the earnings per share that was previously $2.10 per share is now $2.02. And so we need to report both of these numbers, basic and diluted, on the face of the financial statement. Some other details that you need to consider, if sometimes the conversion rate can occur during a change in the conversion rate can occur. If that happens during the year, we use the most dilutive one, the one that converts into the most shares. I also want to remind you that preferred dividends do not reduce net income, and therefore are not subject to the 1 minus T effect, the tax effect. There is no tax at the corporate level on preferred dividends or effect on income, taxable income of preferred dividends. Otherwise, preferred dividends are treated the same as convertible bonds. Let me show you an example here. The example is prior to the current year, Barclay Company issued 40,000 shares of 6% convertible cumulative preferred stock, $100 par value. Each share is convertible into 5 shares of common stock. Net income for the current year was $1.2 million. There were 600,000 common shares outstanding during the current year. There were no changes during the year in the number of common or preferred shares, so we don't have to worry about the weighted average computations. Compute diluted earnings per share for the current year. Keep in mind that we're talking about preferred stock here that's cumulative. We are not talking about bonds. So in calculating the basic earnings per share, we've got to have net income 1.2 million minus the preferred dividend, that is 40,000 shares times $100 per par value, 4 million times 6% is $240,000 of preferred dividend, gives us 960,000 of income available to common, and we divide that by the weighted average shares of common that were outstanding, 600,000 or $1.60 per share. Remember, every company must report basic earnings per share. Now, let's do the if converted method. Start with the $1.60 basic, and we're going to say, all right, we're assuming that the preferred stock is actually converted, so our income available to common would be 1.2 million because you would not get the dividend if it was converted. And then if it was converted, it would be converted into 200,000 shares. Each share of preferred is convertible into 5 shares of common. And so the marginal effect is going to be 240,000 divided by 200,000, or $1.20. And notice that that has a smaller effect than the basic earnings per share. So when we add across here, we're going to end up with 1.2 million in the numerator and 800,000 in the denominator, and our diluted earnings per share is smaller than the basic, it's $1.50, we're going to report both the basic and the diluted on the face of the income statement because it's smaller. Now, here's an example, same thing, but the only thing is that we have, in addition to the convertible preferred, we have option holders have the right to purchase 100,000 shares of common stock at $10 per share when the average stock price during the year was $16. Now we're going to assume that we take the proceeds of the exercise, that is 100,000 times $10 per share. The stockholders or the option holders will pay us $1 million, 100,000 times 10, $1 million. And then we're going to buy that back at $16 per share. And if you take 100,000, hey Siri, what is a million divided by 16?
1 million divided by 16 is 62,500.
62,500. So we have the 100,000 minus the 62,500, and that gets us the 37,500. All right. So notice that the stock options do not affect the numerator. They don't have an income effect. They just dilute in the denominator. And as long as this number is positive, you will have a dilutive effect on positive net earnings. And so we have a diluted earnings per share of $1.43 and basic earnings per share of $1.60. And you must report this on the face of the income statement. In this one, if in C, if the shares are only convertible into 3 shares of common stock instead of 5, then we go through it and we see here that we have the same basic earnings per share, and we get rid of the preferred dividends. So we add that $240,000 back. But now, instead of convertible into 200,000 shares, they're only convertible into 120,000. And this has the positive effect of on earnings per share compared to the $1.60. And when we calculate it, indeed, overall, we would have an anti-dilutive effect on earnings per share. If this is the only convertible security, for example, if we didn't have the stock options, we would only report basic earnings per share of $1.60 because it's anti-dilutive. That conversion rate is anti-dilutive, and we always want to be conservative here and report it as $1.60. So anti-dilutive securities, if the as-if conversion does not decrease earnings per share, then we don't assume that the conversion occurs. And you just assume that it doesn't occur. And if there's no difference between basic and diluted earnings per share, you just report basic. Now, does this matter? Does anybody pay attention to earnings per share? And here's the good news. The work that you do as an accountant does make a difference. On June 24th, 2026, at 4:01 p.m., that is 1 minute after the market closed on the east coast of the United States, Micron issued their press release, and the press release indicated that, and Micron, which is an older company in the United States, but looks to be growing like a weed in terms of revenues and profits. To give you an idea, They went from 9.3 billion revenue for that Q3 in 2025 to 41.46 billion in 2026. A factor of nearly, well, right about four. I multiplied. So GAAP income is $24.67 per diluted share, and they also reported something called non-GAAP net income of $25.11 per share. I report and highlight both of these numbers to show you that while we calculate in this course GAAP net income, analysts and the companies talk about something called non-GAAP net income, which is determined on a per company basis by the managers of the company. And they will add back certain things. And I believe in Micron's case, they don't think stock options have an effect on earnings. So they add it back. And I'll show you that in just a moment. So under US GAAP and SEC rulings, you must present the GAAP numbers first, just as they did. GAAP number was first, non-GAAP second. GAAP is what we use for reporting financial statements, but they can also talk about other numbers if they wish. And up here you can see the difference between GAAP net income and non-GAAP net income. They are adding back stock-based compensation. They don't stock options and other stock-based compensation. They don't see that as a cash cost, and therefore they don't believe it should be deducted. Whatever they choose to do, and they also are adding back this loss on debt prepayments that they don't think that should be considered. It's whatever they believe is a better measure of their profits, and they come up with 28,857,000,000, and that is used to calculate the non-GAAP net income. And you can see the calculation here. If you don't, they exclude the adjustment for stock-based compensation in calculating the weighted average shares outstanding. They follow a logic there, make sure that it's consistent under the different approaches. But what they consider more meaningful than others is completely up to them. And every company seems to do it in a slightly different way. Notice here that we used $25.11 as the non-GAAP diluted earnings per share. And importantly, analysts rely on that, on the non-GAAP earnings per share. They do not focus on the GAAP earnings per share. Let me repeat that. Analysts focus on the non-GAAP earnings per share. And so when we see over here, this is Yahoo Finance for Micron, and you can see that they reported the actual EPS at the non-GAAP number, and earnings had been estimated by analysts to be $20.71 per share, and they came in actually at $25.11. So they blew away, far exceeded expectations, and this is what happened. They reported right after the close of business here, and the stock price went up. What does this tell us? It tells us that people pay attention to the work that we do in accounting. It's valued by the stock market, helps people allocate their capital to the good companies and away from the bad companies. In summary, every company must report basic earnings per share. It's income available to common divided by weighted average shares outstanding. Companies that have potentially dilutive securities must also report diluted earnings per share. That is, we assume that all convertible securities are converted either at the beginning of the year or when they're actually issued, if that occurs during the year. This affects normally both the numerator and denominator. If it's preferred stock that's convertible or convertible bonds, we're going to have a numerator effect. We won't have a subtraction for preferred dividends or an the interest expense effect on earnings net of the tax effect of the additional earnings when we eliminate the interest. Investors use accounting to make their decisions. We saw that in the stock price chart just a moment ago. And companies and analysts use their own variations of earnings per share. And they talk about, so when you hear analysts discussing and writing reports about earnings per share or forecasted earnings per share for a company like Micron, they will be focused on the non-GAAP earnings per share that Micron uses. There you have earnings per share.